Thank you for joining today's webcast, hosted by Hinoki Capital, titled Choose Your Own Adventure. This webcast is our 2018 outlook, and we recently hosted a lunch in early December with a group of investors, and the feedback was strong, and people felt it was very interesting and informative and fun, and we decided to make a webcast out of it and send it out. The essence of Choose Your Own Adventure is a group of books that I read when I was growing up. They came about in the late 70s and early 80s when I was about 7 or 8 years old. And they were very fun books. They had really interesting titles such as Secret of the Pyramids and Lost on the Amazon. And the essence of the book was that you acted as the protagonist in the book and took responsibility for the fate of the character. And as the adventure unfolded, you would approach decision points or forks in the road in the book where the story outcome would change depending on choices that you made for the character. So, for example, in a spy story, you may sneak into a hotel room looking for clues and suddenly hear a noise at the door. If you decided to jump out and ambush whoever it is, you would turn to page 38. If you decided to hide under the bed and see what clues you could learn, turn to page 47. What made these books so fun was that they were very, very realistic and very, very unpredictable. Two aspects that are consistent with what goes on in the stock market. It clearly is very realistic as we get a P&L every day, and it's always unpredictable as facts change. Now, up to this point, the story was written for us by the central banks. The goal was to find a comfortable chair, keep turning the pages of the central bank playbook, be as net long as possible, and enjoy the storybook ending. The Fed was the author of this book as they took their balance sheet from 1 trillion to 4.5 trillion. And as a result, the last 8 years were a moonshot in both duration and magnitude. From the March bottom until November, the NASDAQ is up 442% or 21% per annum. And likewise, the S&P is up similarly, up 291% and 17% per annum. It also worked everywhere. Every asset class, with the exception of commodities, were up. This particular chart starts in 2008 when commodities had just ended a 10-year run of outperforming equities by about ninefold. And so that's the only reason commodities have underperformed. However, the MSCI, the equity markets, the global high yield index all had phenomenal returns during this time frame. Well, that was then. And so now we look forward in this book and say, what is happening now? This is what Goldilocks looks like in literature. This is what Goldilocks looks like in the equity markets. We've seen a QE bonanza globally. If you can see this chart, the JCB, the ECB, and the Fed all provided stimulus, and the S&P followed in an almost 100% correlated fashion along with this stimulus. The S&P is the red line, keeping right up with the global stimulus from the major central banks. We've been benefiting from 3% GDP growth, and that is rising. Now, keep in mind, you'll see the 2008 period, we had those big negative GDP periods. We've been mostly positive from that time, although there was a dip in 11, a dip in 12, and a small dip in 14, and for parts of 15. And we think those dips are important, and I'll show future slides that talk about what we think that was the cause of those slowdowns. Leading indicators are currently improving. You'll note that the dashed line that goes across is where recessions typically happen. Those are the red bars in the chart. And we are nowhere near recessionary levels at the moment. Confidence is building. Consumers feel great. And the recent tax reform probably only adds to that. And it's the first time since the 2008 bottom that we're seeing a synchronized global expansion. This is the equity market return from the global markets. But up until this point, there's been fits and starts in the different global economies, but this is the first time we have all of the global economies firing on all cylinders. Inflation is not too hot and not too cold, to stick with the Goldilocks theme. You'll note that CPI is running at about 2% and has been very, very well contained the whole way back from the recovery. We actually had a deflationary scare, you can see on the chart, in the 2015 to 2016 timeframe. But since then, we've been in this Goldilocks of about 1% to 2% inflation and keeping relatively steady. There's also reasons to believe that it can persist. We think there's a belief in the marketplace that inflation is going to be kept structurally low. We are exporting deflation from emerging markets such as China. We're benefiting from digitalization. For example, it used to cost about $150 to $170 to take a taxi from my home to the airport, and I can now do that at $70 with Uber. We have an aging demographic. The boomers, who are obviously a huge cohort, are moving out of their peak spending years. And we have an economy that is focused on experiences rather than things. Rate worries have also been premature. What you're looking at here is a slide of where economists thought rates would be at the end of the year and where they eventually ended. You can see that the black lines are the prediction and the green line is where rates ended up the year. Economists have typically been about 100 points over where rates have been, with the exception of 1 or 2 years. So the concern about rates backing up has not manifested, and that's really been able to keep valuation moving to the upside. Tax reform, which was just passed, is a further stimulus. 2018 consensus EPS for the S&P 500, we're running about 140. Tax reform will add another $10 to $15 to that, which is up approximately 9% at the midpoint. This obviously has different ramifications for different companies in the S&P 500, but it's a big kicker to growth at a later stage in the cycle. Now let's take a sneak peek at potential future chapters of this novel. Business fundamentals are very solid, but the Fed is breaking up with you and you're afraid to change your Facebook status. We understand why. It's been a fabulous relationship to be dating the Fed. It's led to a great time and a lot of money made. So what do you do when the Fed breaks up with you? You start dating the ECB and the BOJ instead. Now, if you look closely at this chart, it has the Fed, the ECB, and the BOJ's stimulus. And you can see that the Fed actually went to a flat line in 2015 and kept things relatively steady since then. If you remember, 15 was a year where the markets had a bit of a tantrum over this, and also where the returns were quite flat, and we also had a growth slowdown. If you look at what the ECB did, they also pulled back in the 13 to 14 point, and that led to a growth slowdown and also worries about deflation. However, it still feels like a great relationship because when you look at the central bank's total assets in aggregate, they are up and to the right. However, you'll note that the periods of slowdown that I mentioned in the GDP graph earlier also correspond with when the central bank total assets flatlined. It's very much an up and to the right chart, but you'll see periods where there's flat plateaus. Those happen to correspond exactly with when we had growth slowdowns and concerns about growth slowdowns in the equity markets. That relationship, however, is about to hit the skids also. What we're looking at here is estimates from Bloomberg and JP Morgan about what the G4 central banks are going to do with their balance sheets. And after a steady ascent from 2009 till now, those are about to flatline. We're going to see outright reductions in 2018 to the tune of about $400 to $500 billion in the US. And if you look at the forecasted reductions out through the next 3 to 4 years, we're going from a level of about $4.5 trillion down to below $3 trillion at the Fed. Now, we all know markets are made at the margin, and this is perhaps the most important slide in this entire presentation. You can see that back in 2015, there was about $950 billion of stimulus added to the markets. 2016, there was another $1.9 trillion, and 2017 followed up with close to another $1.9 trillion again. 2018 is going to be the first year that not only do we slow down, but where we roll over pretty meaningfully. You can see if you look at the individual components that the Fed is going from flat to outright reductions in QE, down about $400 billion. The ECB is going from enormous stimulus at $1.2 trillion down to about flat. The BOJ is keeping going, but again is down ticking. And we essentially have quantitative tightening at a second derivative change basis. Now, if you move forward to 2019, we are actually going to get tightening in the form of $233 billion. And we think that the markets are not prepared for this or adequately discounting what's likely to come when this starts to play out. No one can predict how this experiment will end because it's just starting. If you look, we're in the very early stages of the Fed going through its redemption process. This is not going to get to a balance point in both redemptions and reinvestments until mid-year of 2018. And thereafter, we think it'll continue to surprise markets as to the effects on interest rates. There is also finally an alternative. You hear about it in the popular press all the time that people talk about there is no alternative to equities. The Fed essentially has driven us into risk assets. And it makes sense. If you look at the Fed funds rate, it's been on the zero bound from 2009 all the way through 2016, with inflation running at 1 or 2%. As a result, people took that capital that was not getting a return, they poured it into the equity markets. This is the first time that we're at the end of negative real rates. Again, you're not going to get rich in putting your money in the bank account, but it's the first time that we're moving into an area where there is an alternative. We also think we're starting to get early indicators that we should be reducing equity exposure. If you look at the real return on invested capital in the US, which is operating profits divided by current cost of invested capital in the left-hand side, and then you look at it in the right-hand slide, this chart compares the ROIC to the long-term Treasury bond real yield. And if you notice, when the ROIC is above the long Treasury bond real yield, it pays to be all in equities or risk on. That's when the red line is over the black line. I should also note that the black line is a 10-year moving average, and the blue bars around it are 1 and 2 standard deviations above and below that 10-year moving average. When the red line dips below the black line, it pays to be more underweight equities because the ROIC is starting to under-earn what you can get from a risk-free rate. Again, this isn't a wonderful timing tool, but it directionally speaks to where your money is treated better, and it's the first time that this measurement has dipped below the midline since the '08 crisis. It's very early cycle as far as economic data points, as we mentioned earlier, but this is happening at late cycle valuations. The cyclically adjusted price to earnings ratio is hitting levels that it has hit only 2 other times in the past, in the 20s and the early 2000s. This is a very good long cycle predictor, but admittedly it does have its flaws. Because it's cyclically adjusted earnings, it doesn't pick the tops and bottoms, but it directionally tells you, are you really expensive or really cheap? At the 94th percentile, there's probably not much room for expansion. If you look at this chart, we've been able to breach the 90% level 3 times in the last 20 years. Interestingly enough, if you go back prior to this, and this chart goes from the 1880s, there's only been 3 other instances prior to the last 2 decades where you got over 90%. One was in the late 80s, the other was in 1929, and the next was in the late 60s. We've had 3 chips over the 90% level recently, and those also corresponded with pretty difficult market periods thereafter. This has been talked about as Buffett's favorite indicator for valuation. He looks at corporate equities to GDP, and as you can see on this valuation basis, we're below the peak hit in 2000, but north of the peak hit in the 70s, and generally elevated. A variant of that is looking at the Wilshire 5000 to GDP, where we're just about up to the levels of the 2000 timeframe. Mean reversion is obviously a very powerful concept in finance, and what this chart looks at is looks at the trend line of that valuation and shows that we're about 31% above the trend line valuation. This looks at that same chart, detrends it, and looks at standard deviations. On this basis, we're about 40% over the trend line regression of undervalue versus overvalue. This chart compares asset prices to GDP. The red line is US nominal GDP, and the blue line is net worth of US households. You'll note that the dot-com bubble, which happened in the late 90s, brought us well north of that line. And then we had obviously the dot-com bust. And as the net worth came back to US nominal GDP, the Fed stepped in to avoid a recession, lowered rates, and created a housing bubble. After that, we had a very, very bad recession and a significant crisis. And then the Fed stepped in again and created another central bankers bubble in the form of QE. A couple points to note. This chart is not logarithmically scaled. So you'll see that the left-hand axis goes up in standard increments. But actually, if you look at the percentages, they're quite equal in each of these bubbles. The other thing to note is that it typically takes about 5 years of extension before you get the correction. The dot-com bubble was 5 years of extension. The housing bubble was 5 years of extension. And then the central bank bubble, if measured from the 2012 timeframe, was about 5 years, 7 if you go back to that 2010 timeframe. We're wondering if this is a pattern as to when things get too elevated and need to correct. The ECB has also followed the Federal Reserve's lead in this way. This should not happen. Euro junk yields should not be below US Treasuries. If you look at back during the crisis period, the Euro high yield index was trading north of 20 and has since come down all the way to the point that it actually costs more to borrow in US Treasuries than it does in Euro high yields. Another way to look at this is through the individual countries. When markets are behaving efficiently, countries with high debt loads, low growth, and structural challenges will have to offer investors a higher interest rate to borrow their money. In 2012, that rate was a full 5 percentage points higher in Italy than the US. That made a lot of sense. However, in the summer of 2012, the ECB announced its intentions to prop up the European sovereign debt market directly. This chart starts in 2012. You can see that once the ECB did that, rates got on a steady downward trajectory for Italian bonds, so much so that you get paid less in interest to take on the risks of the Italian sovereign bonds than you do in the US by almost 50 basis points. This is even worse in Portugal, where it cost you received a full 10 percentage points more of interest to take on Portugal sovereign risk. And now that is down to a negative 50 basis points. And then the granddaddy of the pigs in Greece, during 2012, you received over 25 percentage points more in interest to take on the risk of Greek sovereigns. And now that is down to only 170 basis points more than in the US. Again, this doesn't make sense. And the effects of central bank intervention are leading to unintended consequences in the marketplace that we think are going to revert back. Speculative juices are also flowing. When we initially did this lunch presentation in early December, Bitcoin was trading at about 8,000 when we were putting the presentation together. A week and a half later, when we actually gave the presentation, it was 14,000. It obviously hit a peak of 19,000 or 20,000 a few days ago and is now trading actively at 14,000. The moral of the story being, if you're going to talk about Bitcoin, don't put a chart in the presentation. Instead, put pictures of things that speak of the speculative frenzy. This harkens images of the 1929 Shoeshine Boy stories, where individuals that have nothing to do with the stock market are talking about Bitcoin. And obviously the guy on the left is not Satoshi Nakamoto. And obviously the guy on the right probably doesn't have an ability to collect Bitcoin in that wallet that he's showing right there in the right-hand side. We are major believers in blockchain. However, we think it's probably going to build and bust like the 90s did in the internet. We were investors during that time, and it was very, very crazy. But after the crash of the internet, you had enormous innovation and enormous companies built. This is similar to the canal companies. This is similar to the rail companies. This is similar to the auto companies. And it's the same pattern you see again and again in really innovative situations. What you'll typically find is that there's a euphoria period where things go crazy, but then after the eventual bust, the real big businesses and the real winners are born. It's pretty amazing to believe that Google came 4 years after the internet bust in 2000. The iPhone came 7 years after that, and then Facebook and Twitter thereafter. We think this slide is fun. We don't have a particular point of view about Tesla, and we know there's a big debate as people who are long or short, but this again speaks to speculation in the equity markets. You have a company that struggles to make cars and make them on time. You have a company that basically loses $7,000 to $9,000 per vehicle and is unsure of if their battery technology is going to be on the appropriate cost decline curve. And the subset of that is Tesla investors. Now, it's been a wonderful stock, but it's pretty interesting that a company that's never made a profit can float $2 billion of debt or issue equity in the markets after hours without taking any price hit. And that's just a symptom of where we are in the speculative frenzy for anything that has a future dream. There are other potential flies in the ointment. Debt has doubled in 8 years in the US from 10 trillion to 20 trillion. We are also mortgaging the future. We borrowed this term from Stanley Druckenmiller, who talks about generational theft. It's interesting to note that if you look at this chart, we typically have budget deficits get worse during periods of recession. If you look at every period of decline, it's been after a recession. And then we get our house back in order after the recession and we see surpluses. This is the first time we've had 3 years of deteriorating budget deficits without a recession. It's a first, and we think it harkens problems down the future, particularly since we just put a $1.5 trillion tax reform bill in place, which is only going to add to this problem. Economic revisions are as good as they get. This is the Citigroup Economic Surprise Index. And what it looks at is economic surprises relative to expectations. How this works is that economists forecast what they think the economic data released is going to be. And if it misses those expectations, you get a negative reading. If it makes or beats those expectations, you get a positive reading. Now, this is a mean reverting series because what happens is after tough periods, people lower their expectations. They're invariably beat. The series rebounds and goes back up until people get excited again, and then those are missed. If you go back and look at the beginning of this chart, you'll see that this is a pretty long-term chart. It goes back to 2003. It's very, very difficult to get north of the 50 or 60 bound on the upside, just as it's really difficult to get north of the 75 or 100 bound on the downside. Obviously, those most difficult points are during recessions. We're currently up at 77, which means that economic surprises are about as good as they get relative to expectations, and there's a pretty good likelihood that people will be disappointed in what the forward economic expectations turn out to be rather than what's being discounted right now. We also think this is a really interesting slide. Are fixed income markets seeing something that equity markets are not? This looks at 30-year yields minus 2-year treasury yields, and it's really important to look at that lower dashed line. If you look at that point, every time we've pierced that to the downside, there's been a problem. The mid-90s, the late 90s into 2000, and then the 06 to 08 period. The fixed income markets are always focused on return of capital rather than the equity markets, which are typically focused on return on capital. And we wonder what the fixed income markets see here that the equity markets are not thinking about. We also think that the rate rise consequences are unknown because we've been in QE for so long. Going back to the last few times that loan growth rolled over, it typically required significant increases in the Fed funds rate and also at significantly higher levels. Looking back to the 2000 timeframe, loan growth rolled over after Fed funds were raised from 5 to 7%. Then, of course, we had Fed funds taken way down, loan growth got going again. In the 04 timeframe, rates were raised from 100 basis points all the way up to 550 basis points, and loan growth rolled over again. However, there's something really interesting going on this go round. C&I loan growth has rolled over with a very, very modest uptick in rates off the zero bound. So we've basically gone up 100 to 125 basis points, and loan growth has rolled over from 5% to 3.5%. Again, we think there's going to be unintended consequences that aren't completely being understood by the market. We teased you earlier with the talk about persistently low inflation. For all that talk, you're starting to see some signs of inflation starting to hook up. This chart pattern is a classic reverse head and shoulders. And while we're not through the Fed's 2% inflation target, we think there's a chance that it heads in that direction. And if it does, we think that the rate rise worries are going to increase. This is another way to look at the same chart, and you'll see that there's been a steady downtick in inflation from the 2012 period all the way through 16, but both that series of red bars and black bars is starting to hook up. What was making a series of lower highs has now started to punch through and look like it's changing direction from a trend perspective. Producer prices tell a little bit more of a dangerous story than CPI at this moment. If you look back, we're at levels that we haven't seen since 2012. On the less volatile food and energy component, which is in the blue bars, you'll see that we're also breaking out and above levels that we peaked at in 12, 13, and 14. We think this is directionally to the upside. Again, you'll note that when PPI went down to the minus 1%, we had deflation worries in 15. Again, that was a tough year in the market. We think we might be on the other side of ice and moving to fire, where producer prices may have some pressure to the upside. Domestic politics are also dysfunctional. If you look back at the bell curves of where Republicans and Democrats used to overlap in the 90s and the 2000s, this is where laws were made, where moderate Republicans and moderate Democrats would get together and be able to craft legislation together. Obviously, the 2017 chart drives us all crazy in that nothing gets done and all there are arguments. It's pretty interesting to us, again, politics aside, that tax reform was jammed through by a group that just won the election against a group that lost the election. And we think that it's pretty interesting to note that in the 1980s, Reagan's tax reform took 2 years to put together, and we think was a little bit more thoughtful than what just got jammed through in this most recent session. Regardless of your political bent, the U.S. is pulling back from global leadership on a diplomacy, security, and trade perspective. And what we worry about is that others will fill the void. We don't know what the potential geopolitical problems could be. North Korea obviously could be on this slide as well, but we think that geopolitical risk has increased over the past several years rather than decreased. Market structure has also changed permanently during the last several years, and this has happened during a raging bull market. And so we think that the ramifications of what happens during this market structure change are going to be tested when we actually have some downside. Quants have clearly altered the landscape. There are a lot of estimates out there that show that quant trading can represent anywhere from 50 to 80% of a given day's trading. This is the picture you find when you Google Wall Street fat cat. And what we're seeing is that ETFs and factor baskets are exploding, and it's having significant influence on how stocks trade. We picked the retail spider and the Qs as an example of what happened after the tax reform bill went through just about a month ago. You saw retail rally like crazy, big tax beneficiaries, and tech sell off like crazy, big non-tax beneficiaries. And you saw companies that missed earnings and were troubled during the prior period rally like crazy, while companies that had made earnings that were technology companies sell off quite violently. And we're seeing this happen over and over again in the marketplace. And again, at this point, it's only been rotational, but we're not sure what it's going to happen when it might be happening during a market decline. Intra-sector correlations have skyrocketed. You can see that back in the mid-90s, intra-sector correlations were about 50 or 60%. And what this means is on any given day in a particular sector, the stocks were about 50% correlated, meaning some would be up and some would be down. But now those numbers are close to 90%, which means that the baskets that are being traded are impacting entire groups of stocks, making them go up and down as one particular cohort. While this has happened, inter-sector correlations have plummeted. Many of the equity market participants and the quant players have become macro traders, deciding when they want to be long something and short something and making risk on and risk off trades on a daily basis, again, leading to shorter term volatility. We wrote a letter about this 2 years ago titled Sector Rotations in the Fishbowl, with the point being the fish are stocks. And when the fishbowl tilts to the bearish view, whether you're a shark or a minnow, it's very, very hard to swim against the tide. The same thing goes for the bullish view. When it tilts to the right, even the worst stocks go up because they're in part of an ETF that takes them higher. Keep in mind, everything we're about to show you has transpired without anything being wrong economically or globally. The flash crash back in 2010 took 7 percentage points off of a major index in a matter of minutes. Another flash crash in August of 15 had a similar effect. Brazil was down 19% in the course of a morning, and the treasury markets traded from a yield of 215 down to 185 in the course of 10 minutes. Our treasury markets are supposed to be the deepest and most liquid in the world, and they can be battered around like this and then snap back to 215 or the same yield they started the day in the course of 6 hours. As an example, in that August flash crash, Apple went from 106 to 92 in 2 minutes. That's $73 billion worth of market cap. Pharmaceutical stocks are stable, not so much. J&J down 15% in 5 minutes. And what's also a little eerie for an equity investor and someone who looks at intraday charts is that intraday charts are supposed to have a continuous pattern to them. There's supposed to be a battle between buyers and sellers. What you see here is a gap down at the open, a flat line, and then when no buys come in, another gap down, and then a snap back to that first level and sideways through the rest of the morning. This also should not happen in large caps. This is UNH, a very, very large cap, stable company. gapping down on that same morning. And what's disconcerting here is how hollow the markets are. The market traded nowhere, for just down into the right for 7 or 8 minutes before bouncing back. Again, this is computers, this is flash crash action, and again, this is transpiring with nothing being wrong. We ask, are ETFs and levered baskets this generation's portfolio insurance? We aren't predicting this. However, unintended consequences do occur in finance. We're not predicting anything like an 87 correction. This was obviously driven with interest rates being raised up through the free cash flow yield of equities, and it led to a very significant drawdown. But there's a lot of parallels as far as instruments, portfolio insurance, looking like ETFs and quants, and interest rates going up compared to the earnings yield. We're not quite to the levels yet, but there are a lot of parallels between that period and this period. We've witnessed a lot of calm, and we ask, can it continue? This is 28 years of the VIX, and it's important to note that the VIX typically doesn't go below the 10 or 11 range. And it can stay there for a year, sometimes longer, but it is an absolute bound, which is hard to pierce to the downside. We do think going forward that there's going to be more trips into the 20 range and the 25 range, which is a bigger volatility quotient. Again, not a bear market, but this unprecedented calm that we're witnessing probably doesn't continue. Looking at this chart, one would bet that the VIX will be higher in the future years than lower. This amazing chart shows that we've now had no 3% drawdowns for 291 days and counting. We pulled this chart back from October of 17, but updated it for the current period. This goes back to the S&P's longest winning streaks without a 3% drawdown all the way back through 1928, and we've now surpassed that. Again, an unusual and unreal amount of lack of volatility in the marketplace. Common knowledge in game theory is something that's known by everybody. The financial example is, as the central banks pull back, I have to be cautious about a rate rise. At a certain tipping point, investors will panic. I will panic first. This is what common knowledge looks like in literature. Look, that emperor has no clothes, the little girl said. Everybody knew that. However, it took the little girl to mention it before everybody started pointing and laughing at the emperor. We think this is what common knowledge looks like in equity markets. This chart is from a respected group at RenMac that we follow who do outstanding technical research. And what they're looking at is when a backup in rates are going to have a probability of mattering in the equity markets. I've seen this at 3.6 mattering as the level. I've seen other economists and strategists talk about 3%. The point is there's people who believe that there's different levels that will matter. Everybody has a level plugged in their computers. As rates start to back up, we're going to hit that tipping point where the computers and the preponderance of investors decide it matters, and we think things have the potential to be pretty volatile when that plays out. What inning are we in? We're not sure. We definitely know it's the later innings of the ball game, the 7th, the 8th, the 9th inning. It's definitely not the earlier part of the ball game. Things can go on for longer than one thinks in the equity markets, but we think it makes sense to start to prepare for a more difficult environment going forward. We're definitely not in the early innings. Another way to look at this is stages of investor emotions and trading psychology. We've all probably lived through maybe the markets just aren't for me phase. Obviously, that was the 08 to 09 phase. But we're on the other end of this now, up by that, wow, I feel great about this investment. Bitcoin is probably up in the thrill to euphoria stage, whereas the equity markets are somewhere between excitement and euphoria. Again, we're not sure when this ends, but it makes sense to start thinking about the other side of this curve, particularly with central banks stepping back as aggressively as they are over the next 2 years. Short selling is a 4-letter word in a lot of markets. In a bull market, it becomes even more so, but we believe it is unbelievably valuable. Why is it a 4-letter word? Well, because markets go up 2/3 of the time historically. Your potential gain is 100% and your theoretical loss is infinity, and position sizes get smaller for you as your ideas work. Big money is only made once the bull case is broken. Up until that time, every pullback is an opportunity for investors to get longer the stock. With 10% short interest, that means there's 90% of holders who want that stock higher. You're fighting on a 9-to-1 basis against everybody else who wants to make money on the long side. This makes shorting very, very difficult because you only really get that payoff once. Quality has also been a useless predictor ever since the Fed started QE. The yellow line is the S&P 500, and you can see that in this time series from the March bottom, it's up about 297%. The white line is the quality index, and the quality index is 1,000. Deutsche Bank takes 1,000 global large cap companies and screens them for return on equity, return on invested capital, accounting accruals, common ways that investors might think about looking for quality. And in order to create a market neutral index, it takes the top 20% quality companies and goes long, and takes the bottom 20% quality companies and goes short. Since the bottom in 2009, doing that has yielded you a grand total of 2.8% return relative to the market, up 297%. Effectively, quality has not mattered, which is exactly what the global central banks have wanted to happen. They wanted to inflate equity and asset prices, and they did that. Everything has gone up without regard to its quality, its earnings profile, or whether it's a good company with a good management or a bad company with a bad management. This has made shorting particularly difficult, and we think this is about to change again as the central banks move back from their very, very aggressive stimulus. We ask the question, are we masochists? We don't come to work every day and dress up in a paper mache piñata costume, but feeling like a short seller, being a short seller can feel like that sometimes. The reason we short equities is because we know they are the only true effective protection in a market decline. The reason we know that is because we have experience at our prior firm using futures as hedges, and they don't work very well. The problem is futures have a beta of 1 when most of your longs in your portfolio have a beta far higher than that in a downturn. We created this hypothetical example to prove the point. On the left, you'll see an example of a stated net exposure, 100% gross long equity, 40% gross short equity, and 40% gross short futures. Your stated net exposure is 20%. However, your behavioral net exposure is 50%, because most of us like to go long and short things that move. We're involved with stocks that have more beta than the overall market. In an environment where somebody is 100 long and 40 short for a 60 net, on a beta adjusted basis, it's more behaving like 150 minus 60 or a 90 net. Then what happens is when the market goes into a downturn, you put futures on top of it. However, those futures only have a 40% exposure times their beta, or 40%. You look at your portfolio and you feel defensive, and you're looking at your stated net of 20. However, your behavioral net exposure is closer to 50. And the struggle is, this could be even worse if you have individual equities that are starting to gap down. And without a short position that matches it, that behavioral net exposure can be even higher than 50. I've had plenty of situations where I have a stock that I really love that's a great long-term investment, but when the market starts to go down, on days when the market's down 1 or 2%, that equity is down 6, 7, or 8%. Futures are going to do a very, very poor job of hedging that position. The only thing that's going to hedge that position is another equity that has similar characteristics in a similar sector that's going to behave with the same type of beta during a downturn. ETF characteristics are often not ideal as well. What we're looking at here is the percentage of each position in the retail holders ETF. When one shorts a retail ETF, you're shorting 18% Amazon, perhaps something that you don't want to do. You're shorting a 7, and 5% position in Home Depot, Walmart, and Costco, respectively, probably 3 of the best big box retailers in the world. You're also shorting companies like CVS Health or Walgreens, very, very defensive companies. This means that you're not shorting the worst companies like a Sears or some retailer that's getting disintermediated by Amazon, but a broad basket, and this isn't going to act as an effective hedge when things really get difficult. Looking at it in the semiconductor holders index, you're also short a basket of companies that you probably don't want to be short. Intel is a 10 or 12 multiple of free cash flow. Qualcomm has a stated bid out from Broadcom. NVIDIA is probably one of the best growth stocks of our time. TI and Applied Materials are 2 of the highest quality, best free cash flow generating companies in the entire technology supply chain, not the best high quality short candidates. Shorting individual equities also has other benefits. It helps you manage a long portfolio effectively, especially when it pulls back. Most investors would like to believe that they're automatons and they're unemotional and they can do things when the market goes against them. But for all of us, we all have an emotional quotient that feels better when we have an offset when the markets are going down. It allows us to make unemotional, logical decisions as opposed to feeling pressured and doing foolish things. Also, shorting individual equities helps us avoid making market calls. When you're short futures, you're constantly making a market call on where you think it's going to bottom. Shorting individual equities allows you to short and then cover individual stocks when they hit price points, allowing you to get out of the position and get longer when something has run its course. It also keeps one balanced in our mindset. There's a famous Anais Nin quote that says, "To the man with a hammer, everything looks like a nail." We approach every idea without bias or predisposition. If you're a straight long fund, you tend to look out 2, 3, 4 years in your discounting because that makes it easy to justify your long ideas. If you're a short only fund, you're typically a pessimistic curmudgeon. Nothing against short sellers, but that's the case. And we think it's much better to be balanced, to approach every idea without any type of disposition as to, does this equity make logical sense or not? Shorting is also a process. It can't be turned on and off based on perceived needs. You need to have a runway of work just like you do on the long side. If you ask most long investors, how do you go about doing your work on the long side? They will tell you about countless hours of work, phone calls, conference calls, 10 Qs, modeling, talking to the managements multiple times throughout multiple quarters to really understand the story, and then waiting for the just right price to get long the equity. However, if you ask them about the short side, they'll say, well, we just jam on an ETF when we think it makes sense. Well, again, that may have worked during a period when things have been benign, but ETFs don't do nearly as good a job of hedging you to the downside. And as a long short fund, we think it's really important to bring acumen on both sides of the table because the payoff is more episodic on the short side than it is on the long side. When you're a long investor, you typically make money for long stretches of time and then lose money episodically and violently. This is just the opposite than on the short side, where you lose money for long periods of time and then you make money episodically. It's very, very important to have a runway of work and a short process in place at all times because none of us know exactly when that down month, quarter, or year is going to happen. And the likelihood that you catch it and protect it, if you're shorting all the time and you have a short process, is far higher than if you just try to step in with ETFs or futures. Every downturn has its poster children where if you can be ahead of the curve and catch them, you can make a lot of money. There's three examples listed, ones we all know. The only likelihood that you're going to catch those things, though, is if you're in the trenches, working the ideas, understanding the valuations, and understanding what's likely to make them roll over. You have a much better chance of catching the eye of the storm for each downturn if you're in the trenches with a runway of work on each short position. Here's an example that we picked from the XLE Energy ETF in 2015. You'll note that the positions are the top 5 positions in that ETF, and they represent close to 60% of the weight of that ETF. On average, they were down 30% in 2015. For example, we've pulled 5 of our energy shorts during that period, and these positions were down 70% on average. 1, a much better hedge. 2, a much better money-making idea. And 3, it became very, very easy to time these. C&J Energy, for example, was a bankruptcy, and the company was hemorrhaging and burning so much cash that at no point during that 2015 downturn were we tempted to cover because we felt pretty strongly that it was a bankruptcy. Similarly, Emerge Energy was struggling with an enormous amount of debt, and that allowed us to hang on to that position far longer than we would have been able to hold on to the XLE. The point being, when you're in a downturn, if you're in the trenches and you have a runway of work, the hedging payoff, the shorting payoff is massive relative to compared to what you can do in an ETF. Shorting also is likely to be easier if stocks will follow earnings. Looking back prior to central bank easing, U.S. equity prices in the dark blue line typically followed earnings revisions in the blue bars. However, that relationship broke down significantly in the 2012 through 2015 timeframe, where although earnings revisions were negative, equity prices went north anyway. This has started to go back to a normal period, if you notice, right about 2015 when the Fed started to go sideways in its bond buying and its QE. And you'll see that we're starting now to follow earnings. We think this is a very positive. This is a positive for shorting because it gives the short seller an opportunity to actually put capital to work and get paid if they're right, rather than getting run over regardless. Correlations have also started to dip down. Now, earlier on in this presentation, I mentioned that correlations have gone up in the short term. That's on a daily basis. This is looking at correlation over a 100-day basis. If you look prior to 2008, the left-hand side of the chart, correlations were quite low. We call this stock picker's heaven. However, after the crisis and after QE, you started to see that macro trends would dominate. And that has been in place all the way from 2008 up through effectively 2016. Again, we're starting to see correlations get back to levels that really help from a stock picker's perspective. Subin found this whack-a-mole online and thought it would be funny to put my picture on top of it. But this is how we think the investment game has become, which is in order to knock down one head, something else has to pop up. You can't have big long-term performance, consistent short-term performance, no vol, high stability, and no drawdowns. This is a null set, even in the unbelievably strong bull market we've just had. And we think that moving into a different regime, it's going to be more difficult to knock down as many heads and keep them all down. And so it's important to think about how one behaves and what's likely to play out going forward. With a regime shift coming, it's time to not look in the rearview mirror, but rather to focus on what works in the future. We aren't putting high odds on a deep bear market or a violent correction. However, with the economy late cycle and rates going up, things are likely to get a lot more choppy going forward. And choppy markets are usually defined by significantly higher volatility and stocks that tend to overshoot. We think what worked in the 2017 timeframe is going to be very different than what will work going forward from here. Concentration was phenomenal during the past 8 years. There are many funds that had 7 and 8% positions in the FANG stocks and did spectacularly well. We also were beneficiaries of some of these equities during this time frame. However, going forward, we think smaller positions will make more sense. In a more volatile environment, you want to have smaller positions so that you can trade around them, and two, be in a position to be much more offensive when your stocks overshoot. There was also a long period where factor bets worked, where it made sense to be very long retail, a very long tech, and very short retail. However, we think going forward that we're in a much more neutral market regime where valuations are more balanced, return on invested capital is more balanced, and it makes sense to have a balanced portfolio as opposed to being very long or very short a group. In addition to that, with all the factor trading going on, these factors tend to overshoot. The likelihood of getting offsides and losing too much capital in the short term is high when these factors overshoot due to ETFs and double and triple levered instruments. High gross leverage worked in the prior 8 years because there were no big drawdowns or factor rotations that happened long enough where you could be upside down on your gross leverage. We think going forward, low gross leverage makes more sense, again, as volatility increases. Long bias worked very well. We think going forward, lower net exposure will work well as things get more difficult. ETF hedges worked up to this point, but again, they worked because they were a quick, easy way to put a hedge in place without really having to protect the downside. If we move into an environment where protecting the downside gets more important, individual equity shorts will be significantly more valuable. Long alpha was all that you needed over the past 8 years. Going forward, we think short alpha will be very important. And during the past 8 years, you only had a hedge against sector rotations, whereas going forward, we think we're going to have to hedge against actual market declines, which have very different tactics than what just worked. We've spent a lot of time on the macro, but we are a bottom-up, fundamental-driven investment firm. We focus on 3 main areas: tech, healthcare, and consumer. And we thought it would be helpful to spend a minute or two on a couple key themes in these areas. There are certain times when we reach inflection points in technology. This slide has a red circle titled, "Where is the car?" And what you can see is this is Fifth Avenue in the 1900s. There's one car in a sea of horse and buggies. Fast forward 13 years, and the question is, where is the horse? The red circle is the one horse and buggy surrounded by hundreds of cars on that same Fifth Avenue. There are points in time when technology has quantum leaps. We believe we're living through one of those times right now, and it's due to the exponential growth that we're seeing in semiconductors. To best explain this, we think the fable of the chessboard is a great example. There's a 6th century fable that the inventor in chess from India invented the game, and the king became so smitten with it that he offered the inventor anything that he wanted. The inventor said, "I'm a modest man. How about you give me 1 grain of rice on the first square of the chessboard and just double it on each square, 2 on the second, 4 on the third, and so forth?" The king said, "Granted." What the king did not realize was the power of exponential growth. On the first half of the chessboard, at square number 32, a pile of rice that big would be 2 billion grains of rice. A large field, not a problem. Square number 64 at the end of the chessboard leads to 18 quintillion grains of rice. That's 18 with 18 zeros behind it. That's more rice than there's ever been produced in the history of the world. It would weigh about 210 billion tons and cover India with a meter-thick layer of rice, and will require rice fields covering twice the surface area of the earth, oceans included. The fable then goes on to say that the king had the inventor beheaded. So the first rule is to don't try to fool the king. But more importantly, we think this has significant ramifications for what's going on in the technology space. If we take the same analogy and apply it to semiconductors and Moore's law, semiconductors started in 1958, and they doubled about every 18 months, reaching the middle of the chessboard about 2006. However, we're now past the first line of the second half of the chessboard, and what we're seeing unbelievably profound innovations coming out of technology. That's because the processing power of semiconductors is reaching the point where the gains are so unbelievably large that it leads to significant innovation. When one thinks about artificial intelligence as a for example, it's not that computers have figured out how to become smart. It's that we're figuring out how to take brute processing power and go through a million lines of code and come back with an answer in a fast amount of time. That's being done on the back of semiconductors. Semiconductors are sitting at the base of AI and blockchain and Internet of Things and big data. And so what's happening is we have multiple product cycles going on in tech in a way that we haven't seen up to this point. We have a bunch of technology themes that we'd be happy to talk to you about, or you can peruse here. They relate to digitalization and big data and artificial intelligence and the Internet of Things, automobile content. Again, all of these things are on the back of that semiconductor theme that I just talked about. We also have the semiconductor businesses themselves enjoying enormous structural improvements, and enterprises are re-architecting the way that they buy technology goods and employ technology goods. We think tech is going to be a very ripe area for years to come as we're just moving into the second half of the chessboard. Touching on consumer for a moment, there's been a lot of talk about Amazon and what Amazon's doing in the consumer space, and it's obviously significantly important. However, we think that misses another underlying theme, which is very powerful, which has to do with preferences and values. We have a picture of a food selfie because we think it represents a shift in this value structure. If I would have told you 10 years ago that we'd be taking pictures of food and putting them on Facebook, you would have thought I was insane. But here we are, all of us taking pictures, sending them to friends, and putting them on Facebook. We are valuing different things as a society. We are spending money on different things. For example, boomers are demographically entering different years. They have more interest in travel and leisure and need for healthcare. Millennials are emerging as a bigger spending cohort. They have less ostentatious spending. They prefer experiences over possessions. Ironically, boomers are starting to favor experiences over possessions as well. They focus on individuality. This is leading to major shifts into how and why people spend money, even beyond the logistics and supply chain changes that Amazon is creating. Technology is also accelerating these shifts in the consumer space. If you look at millennials versus non-millennials, those that watch TV, the bottom of the chart, 32% down to 13%. Non-millennials watch TV at a significantly higher rate than millennials. When you think about this, technology is breaking out of technology. It's dramatically impacting every sector of the marketplace. It's also doing it in a very fast fashion. Traditional TV networks, media and advertising around those networks have been built up since the 50s and the 60s, and you're disintermediating those industries in the course of 5 years. Technology is doing this in all parts of the economy, including consumer, including healthcare, including the industrial space, and others. We have a bunch of consumer themes. Again, I'm not going to spend too much time on these. You can look at these, or if you want to ask us about these, we're happy to talk about them. But in the interest of time, I'll move to healthcare. Healthcare spending is unsustainable. What's fascinating about this chart is it goes back to 1960. And what you can see is out-of-pocket spending on consumer essentials. Essentials represent approximately 60% of the typical consumer's budget. 3 of these lines have essentially been flat. Energy's down and to the right from 4 to 2.5%, 3%. Personal taxes, for all the consternation, are up marginally from 11 to 12. And housing is essentially flat at 14%. The big shift has been groceries, which have gone from 15% down to 5%, and healthcare, which has gone from 4% close to 17% and rising. Healthcare has been growing at approximately 9% CAGR since the 1960s, and this is an unsustainable trajectory, and something has to change. There's no easy answers without innovation and structural changes. This chart looks at where money is spent in the healthcare system. And what's fascinating is that hospital care and home care represents almost 50% of that spending. There's enormous focus on prescription drugs, as an example, as a scapegoat. But if you look, they only represent 10% of the spending. Are there gains to be made from focusing on prescription drug prices? Absolutely. But just like an individual's budget, if you're looking to save money, you don't go to the lowest part of the budget. You look to save money from the biggest part of the budget. And we think there's going to be a re-architecting of the entire healthcare network over the next several years. Companies that are longs are innovators, where they're bringing drugs to market that are leading to more efficacious therapies, or in devices where more minimally invasive platforms lead to better outcomes and lower overall costs. And just like in consumer, healthcare is using technology as well. AI and machine learning are leading to advanced diagnostics and monitoring and a whole host of other benefits in the healthcare system. The losers are those companies that act as middlemen who've been siphoning off the system essentially, but don't really add any value, providing products that aren't differentiated but have been reimbursed in the past. We think the healthcare space is going to be a very lucrative area to be long and short going forward. Again, several themes here listed. These are also, I should mention, multi-year themes in all 3 of these spaces. Which adventure will you choose? Much like the books I loved to read as a kid, we're at a fork in the road. Do you believe the Goldilocks case, the bull case that we have on the left, where politics stay calm, interest rates stay low, the Fed gets out of this normalization process without any accidents, and valuations go a lot higher? If that's the case, the markets have double-digit returns ahead of them. That might happen, but we think it's a fairly low probability, approximately 10%. When we initially did this, we put a 10% probability on the bear case. We were probably being a little bit conservative, but we didn't want to be the low net long short fund that speaks its book. And so we put a low probability on the bear case, but after a lot of feedback from investors at the end, after the lunch, and a lot of phone calls, we think that the bear case likely does have higher probability, and it's okay to put a 20% probability on it. There is a chance that QE ends sloppy and that we do see a slowdown in growth or potentially a mild recession. Quants and ETFs would accelerate the downside in this scenario, and markets could be down 15% or worse. There's a fairly high probability that it's the more moderate case, that even though the Fed steps away, interest rate normalization does not cause too big of an accident. The economy continues to chug along, but even in that scenario, stock-specific dispersion will increase, corrections will become more typical, and we will see a more balance between up and down months in the marketplace. In the moderate and the bear case, there's going to be a different type of asset allocation that's necessary and definitely a different type of fund management. We would put very, very high odds on the two on the right, and we ask you to think about your asset allocations as you choose your own adventure for 2018 and beyond. Thank you very much for listening, and we'd welcome the opportunity to call or email us with questions, comments, disagreements of opinion, or differing viewpoints. And also, please visit us at hinokicapital.com, where we have many contemplations and tidbits that talk about these topics and others. Thank you again.